Asian equities are on track for their best February ever, powered by the AI infrastructure boom and a surge in South Korean chip stocks. JPMorgan's Raisah Rasid will map the market outlook and explain why she is leaning into Asian equities, alternatives, and selective software names. Gold closing out its longest monthly winning streak since 1973. Holding above $5,000 an ounce. UBS precious metals strategist Joni Teves will be joining us to break down the precious metal surge and why a correction may be coming. Despite the software sell-off, foreign investors are rushing back into Indian equities at the fastest pace in 8 months as earnings stabilize and tariff pressures ease. And former RBI Governor Raghuram Rajan joins us to unpack the Citrini report's warning that AI's hit to India's IT services could spark an economic slide, plunge the rupee, and push the country toward IMF talks. Asian stocks headed for their best February on record as the AI scare trade continues dogging US peers. Bloomberg's Avril Hong is here to tell us more. No stopping Asia.
Yeah, Asia's been doing its own thing for this week, right? As we've seen the AI scare trade the past couple of weeks, and then this week from Citrini Research, hypothetical scenario, but somehow causing that plunge in software stocks. It's interesting, we've been seeing a bit of that recovery this week among the US software names. Some funds have called the bottom. You've seen retail participation also buying up those beaten down stocks. But to your point, Asia's been doing okay amid all the ructions. The investor bet on the AI infrastructure build-out that's benefited these chip makers. We've seen TSMC, SK Hynix, Samsung as well, really doing very well this week. We are seeing the South Korean names coming under a bit of pressure today, but note how Taiwan, South Korea, they've been really overboard of late. Investors also finding new ways into the memory crunch trade, right? With the likes of Hanmi Semiconductor, for example. Look at the way it's been surging today. China has also been a bit interesting because we've seen how even though it looks pretty flat on an index level for this year, the AI trade seems to be shifting a little. Investors on the mainland are looking at the homegrown players. So on the Hang Seng, you've seen how Hang Seng Tech has really been underperforming recently. And of course, traders will be watching for the NPC next week for any clues on fiscal stimulus or the plans from the government there.
So optimism generally, and that's also lifting India. I mean, it does seem like foreign investors are beginning to come back.
Yeah, you look at the way global funds, just based on the latest available data, they've actually been buying $2 billion worth of India stocks for the month of February. And this is following on from the exodus last year. But some still think that it's still quite a pricey market. And this week it's been interesting because you look at the Citrini Research, it actually highlighted how the IT exporters, there are some dire predictions there. So we did see some of these names slumping. But you look at some of the other sectors, right? The banks, financial related stocks, they have been doing well in India of late. Then there's the sense that corporate earnings expectations could improve. You also have the India trade deal. But of course, today we're watching out for the India GDP numbers. You could see a bit of a slowing, but this is backward looking. Don't forget the tariff impact for the fourth quarter of last year. Also might be a bit interesting to watch for the size of the Indian economy from this updated framework, because there is a chance that it could pip the Japanese economic size as well.
Okay, so looking pretty rosy for Asia. How do you trade? Let's get perspective. Raisah Rasid is a global market strategist at JPMorgan Asset Management. Good to have you with us.
Thanks for having me.
You believe in Asia. You say that's the way, that's how you should be trading, that's how you should be positioning. But how much upside do we see from here? We saw huge gains last year.
Yeah, so I mean, at least from where we sit, we do think that there's still a lot more room to run. We can break it down to a couple of factors, right? There is that corporate governance story. Now, that is a catalyst that we think would manifest itself into re-rating of, for example, Korean equities in the coming months. The tech story, we do a lot of hardware here in Asia. So while the whole software sell-off was happening in the US, we're pretty much slightly more insulated on that front because we do produce a lot of semiconductor memory chips as well, right? And then there's the whole story about valuations where they're slightly fair. And finally, I think, especially this year, it is proving to be a very volatile year. We're only at the end of February. We still have 10 more months to go. We don't know what's going to happen, but if you really are a long-term investor seeking income, this is the place to go for the high dividend exposure when it comes to stocks.
Are we continuing to see flows coming out of the U.S. into Asia? Is that building up? Is that momentum building?
Yeah, we could see more of that. I mean, there are going to be more institutional retail inflows back into Asia. And that's really, going back to the fact that some of the U.S. investors are seeking to rebalance their portfolio, making it more diversified, more global. Because so far, it has been a very U.S.-centric story, right? I mean, we've seen performances of the Max 7, for example. They've done really, really well. But now we think the priority is to rebalance your portfolio. And Asia is not a bad place to be yet. From an Asia perspective, however, we're very much invested in the US and Asia. Why not look at Europe? Why not look at UK? Because you do get a kind of exposure, especially in the industrial side, financial side. We are seeing more fiscal spending, especially towards defense. That could benefit some sectors as well there.
Do you think the bottom is in yet on some of the US software stocks and the selling that we've been seeing there?
So that software one is a very interesting story, right? Because the whole genesis of that sell-off is a very sentiment-driven. Will a particular AI model substitute the whole idea of SaaS, which is software as a service? Now, when you think about complex enterprise software systems, right, it's not easily substitutable. So yes, you did see a sell-off, and then we saw in the press conference by that company, they're saying, look, we are trying to advance or at least improve productivity around AI. We're not trying to substitute it. And that's why you got some gains back in that software. But we have to be very selective. So we have to look at software companies that have catalysts, that have proving to have AI monetization potential, and earnings revision upwards potential as well. So I think we have to be very selective because some companies might not fare that well in the face of AI, but it's very important to be very selective even in the software basket.
How is that also affecting consumer sentiment in the US? I mean, we're seeing the recent jobless data. Right. That seems to be adding to the sign that we are seeing no hire, no fire in the US. How is that actually affecting sentiment among consumers?
So we know that in the last couple of years, right, the US consumers have gotten a couple of gains. I mean, because of how the S&P 500, so their financial assets on their balance sheets have done pretty well. Now, I think 2026 is going to be slightly different. Yeah, it's going to be a tailwind coming from fiscal because they are getting their income tax rebates coming through in the next couple of months. We are heading to midterm elections. We could potentially get more fiscal rebates through the summer months. That is something like a sugar rush for the US consumer. So we do think that we are going to see a turn up in consumer sentiment over the coming months. And now that the whole dust is settled around the tariff front, at least no longer, we're not talking about the whole peak uncertainty like Liberation Day, we could see consumer sentiment improve going forward in the next couple of months.
And of course, for the Fed, it is data dependent. PCE out. How much has been priced in already?
So, I mean, if you look at the market's pricing, we're thinking about 1-2 cuts this year. But because, as mentioned earlier, consumer sentiment might improve, we could see some of the inflation pass-through really come to hit the end consumers in the coming months. So at least from where we sit, we could potentially see one more cut, maybe at the latter part of this year into 2027. So we are kind of, pushing it back, but we are going to see some inflationary pass-through over the next coming months. So do not be surprised there.
I take your point about tax refunds and helping the U.S. consumer. What about tariff refunds, though? Because that seems to be a bit of a longer, drawn-out exercise.
It is, and we don't know what's going to happen because it's $175 billion in revenue.
And it might not even go to the consumers eventually,
It might not. I mean, it's, obviously some of the importers have to go to the lower courts and really, set their case and see whether they could get it. Like you say, it could be a very, very long, drawn process. I think from where we sit, however, from a fiscal balance sheet point of view from the government is how are they going to plug that gap? So what more can they do on the tariff front? And that's where the uncertainties lie, and that could affect corporate sentiment as well as consumer sentiment. Yeah.
I want to touch on the individual countries as a whole. We talk about how you're liking Asia. We're liking Asia too, by the way.
Yeah.
Korea has been such an outperformer. Yeah. When does it get to 8,000?
Well, don't have a crystal ball, but what I would say is that I think the fears around Korea, especially when it comes to the memory chip cycle, is that, look, we've seen such a good run already in prices, and then there are fears around inventory buildup. Are they double ordering, etc.? But if you just look at supply, I mean, supply is very very tight right now, but demand is still proving to be very, very much intact, right? So I think the whole idea is that as long as the AI story is intact, it's a structural trend, right? We say it's not a one-year story, it's like a 5-10-year story. Then the hardware companies in South Korea are going to continue to benefit as well. And South Korea is not only about the memory chips, because when you look at the industrials, you look at defense, shipbuilding, we've seen earnings revision going up to EPS growth north of 20%. And as mentioned, corporate governance reforms, we've not really seen the whole, the result of it as yet. But you are going to see that re-rating over the next couple of months. So there are a couple of tailwinds that's going for the South Korean market as a whole.
To be sure, though, despite the surge you've seen, it's still a cheap market.
So investors' positioning there, it's not very stretched at this juncture. So we could see more coming through. Yeah.
To your point about the chip makers, do you see a stage where it kind of crumbles upon itself? They're benefiting from the memory crunch, right? But these are also consumer electronics names. Yeah. So does that also become a headwind for some of these? We've been seeing IDC reporting, for example, they're warning of a memory crisis.
Yeah. So, I mean, when it comes to consumer electronics, we do know that it's something that we use day to day also, right? I think the idea here is that how innovative would the next big thing be? Because we know where we get from one addition to another. If there are not many changes, that's not going to move consumers to go out and buy it as well. But I mean, from what we've seen over product launches, etc., demand seems to still be very much there and very much online.
How does the currency factor into all this? I mean, we've been seeing the won appreciating as well.
Yeah, so it's almost like a disjoint, right? Because you've seen the equity market really rally quite a fair bit, but at the same time, the Korean won has not really kept up. So from a cross-asset perspective, there seems to be a very much disjoint over there. Now, obviously, there's technicality around it, which is domestic investors in Korea investing outwards, outside of Korea, etc., and whatever it is. But the thing is that when we just take a step back and think, where will the dollar land? What will be the bias around the US dollar going forward? We do think it's going to point slightly weaker, and that for us think that we could see more capital inflows into Asia.
To what extent is that going to help the Japanese currency?
So the Japan one's slightly different, right? Because we have seen that the BOJ, for example, we could see more reflationist perspective that's going to be on the Bank of Japan Monetary Board. So what would that mean for the currency, etc.? I think that's a slightly different story over there, because obviously we're in a different cycle. So the whole idea is that, what are we going to see on the domestic policy front? Obviously, we're still in very early innings with the new administration, etc. So I think that Japan's slightly a unique story when it comes to that perspective.
And Raisah, I mean, when it comes to China, NPC front and center, fiscal policy growth will be top of mind, and some say 5% is not a problem anymore for China, given how strong exports have been. What are you looking out for? What policy support do you think that will be?
So we've seen the 15th five-year plan, right, already. I think the idea here is that are we going to see more consumer support? How will the government make sure that the urban, the rural salaries are going to start to increase? How are they going to look at technological self-sufficiency? We know that geopolitics is something that is going to continue to evolve. So how would they go about doing that? And the anti-involution campaign as well. So I think more information around that is going to be very central. I know that a lot of investors are very focused on that 5%. Could it be 4.5 to 5 or 5? But at the end of the day, they are trying to build out an AI story. It is a long-term story. Their aspirations to be have GDP per capita to be that comparable to a developed market. That doesn't happen overnight. So I think investors do have to look at China as a longer-term investment opportunity rather than a tactical one.
So what are you seeing in the shifts in Chinese AI winners and the trade there that has, for a large part, been benefiting the Hong Kong names, right, on the Hang Seng? Is that shifting now as they look a bit more to the homegrown players?
No, I don't think so. I think we've seen them really build up very rapidly. And when you just look at capital spending by some of the equivalent of hyperscalers in China, it's still quite modest. So we do think that there's a chance that they could scale quite significantly. And to the extent that's going to benefit the AI story a fair bit also. And we have seen the use case and how China is now looking at humanoid robots, right? It's amazing. So, I mean, if you just think at some of this innovation, there's still a big opportunity there, we think.
Robots doing kung fu. Amazing, amazing moves. Raisah, thank you so much for that. Raisah Rasid, global market strategist at JPMorgan Asset Management. And of course, Avril Hong with us. Still ahead this hour, CoreWeave tumbles on spending concerns while Dell soars on AI server outlook. The split in AI infrastructure stocks coming right up. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. So chip stocks have sent Asian equities surging, but Wall Street has been digesting a rewrite of the AI story as investors reassess the winners and losers. Nvidia, for example, suffered its worst decline in 10 months after the company's latest forecast failed to dispel fears of an AI bubble. For more, let's bring in our Asia Tech correspondent, Annabelle Drulis in Hong Kong. And Belle, Nvidia definitely had a bad day, but then Dell changed the narrative yet again.
Yeah, that's right. It's really been a few interesting moves that we've seen in late trade, but Dell was really one of the standouts because we saw that stock jumping in late trade this morning after we had those earnings coming out and really just highlighting how they're emerging, as you said, looking at the winners and the losers, but they're certainly gaining off the back of this because they said that their outlook for sales of its AI servers exceeded estimates. So it is a sign that they're actually seeing robust demand, essentially. So they're looking at around $50 billion in AI server revenue for the current fiscal quarter, and that was really one of the highlights, of course, of these results, given that their servers are designed to run AI workloads and they are attracting customers from companies that actually rent their computing power like CoreWeave. But just on the topic of CoreWeave as well, as I mentioned it, you can see there how that stock performed in late trade. And again, this was a very different story, but a similar theme that we've heard throughout the earnings season, which is concerns around CapEx and the amount of spending that we're seeing from companies that maybe aren't generating enough ROI just yet, because essentially they saw their losses widening to near 90 cents a share in the latest quarter. And that was well ahead of projections, which was for around 72 cents rather instead, and the company as well saying that yes, they do have strong contracts in place with the likes of OpenAI, Meta and more, but at the same time their capex is going to be $30 to $35 billion this year, and that again is a bigger figure than analysts had been anticipating.
Meanwhile, Belle, we're getting more insights into the effects of the memory chip crunch.
Yeah, this is a really great report that came out very timely, of course, as well. We have seen that huge run-up, and we've been discussing, of course, throughout the shows today just how much Asian equities are primed for perfection or doing very well. The Kospi really the standout performer in February so far, and that is down to the amount of pricing power the likes of SK Hynix, Samsung have as well when it comes to HBM in particular. The issue, though, is when you're having these big players push or convert their capacity and navigate it toward HBM, it does actually have a bearing on more traditional DRAM, and that has an impact, of course, on the smartphone manufacturers that need to put it into their devices. So the overall consequence of that we got from IDC this morning is that it's actually going to have a big bearing on smartphone production for 2026, and they're looking at a 13% contraction on the year. But take a listen, because we spoke with IDC's Brian Ma early this morning.
Just the pressure has been quite immense on the market where, as you pointed out, now we're looking at a 13% contraction. That's putting a lot of pressure on a lot of Chinese vendors, and accordingly so, that actually is about 30% of the total market. So you can imagine that part of the market, when you look towards the tail end of 26 and into 27, we're looking at most of that going away, and that's going to be quite tough.
Yeah, I think IDC highlighted it really nicely there. It's very much asymmetric, the impact that this memory chip crisis has, because whilst you've got those more premium smartphone manufacturers like Apple or Samsung that have more cash stockpiles, they've also got longer term supply contracts in place. Actually, the cost of memory in the total bill of materials for cheaper smartphone manufacturers is much higher, and so they're actually going to be more affected by this. So particularly he singled out some of the Chinese names like Oppo or Huawei or Vivo. I mean, there's a whole host of them targeting markets like India, for instance, with their low-end products. They're saying that anything that's essentially priced under $100 a device is now going to actually end up being uneconomical.
Bell, thank you. Annabelle Drillis there for us. In other news, the bidding war for one of Hollywood's biggest studios might have reached its final act. Netflix has dropped out of the battle to buy Warner Brothers, clearing the way for Paramount to clinch its deal. Let's bring in Manuel Baigori, who leads our deals coverage in Asia. Manuel, give us a sense of why Netflix ultimately decided no go.
Yes, Haslinda, the end of an era, of a saga for sure. And yeah, to your point, I mean, everything has a limit, right? And Netflix had an agreed deal since December with Warner Brothers, but obviously Paramount has been sweetening the offer in different fronts, just the latest $31 a share offer, plus all the sweeteners and tweaks to the potential proposal. It was just too much for Warner Brothers to take a pass, and they had to consider seriously. And then ultimately, they just came out saying, like, "Hey, you know, we believe this offer is superior, and we should engage with Paramount." And obviously, for Netflix, they have to be disciplined, as they said. They believed in the deal, the rationale, strategic from the business perspective, also from a shareholder standpoint, and from a regulatory approval path. They believe it could have been completed, but at the same time, they have a limit and they need to be disciplined. So looking at how shareholders on both sides reacted, it feels like it was a good outcome in the end.
Yeah, that's right. Netflix up by about 8.5% after hours. I'm just wondering if there is a reflection on Netflix's appetite for acquisitions and purchases going forward.
That's a very good question, Haslinda. Certainly one that we should continue to do some digging. But at the same time, I mean, the reality is this was a really, really unique opportunity in a very consolidated industry already. At the same time, Netflix needs to potentially take care of the finances and be disciplined on how much they spend when it comes to acquisitions. This certainly puts them on the map, and for sure they will be in the lookout for other potential targets, even if the size of this one was very unique.
How do you think this decision will reshape the streaming landscape in the next 3 to 5 years, do you think?
Oh, it's definitely transformative. This is a once-in-a-lifetime transformative transaction, Haslinda, and one of those that affect and transform an industry. For sure, we'll have ripple effects not only in the U.S. but globally, right? Given the nature of these businesses, and for sure now the key question is how regulators may or may not approve this, whether there are conditions, and how smooth or bumpy the next few months will be from a regulatory standpoint. That remains to be seen.
Manuel, thank you so much for that. Bloomberg's Manuel Baigori, who leads our deals coverage in Asia. Still to come, gold set to close out its longest monthly winning streak since 1973. UBS's Joni Teves will be joining us with a precious metals outlook next. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside. Gold set to close out 7 months of gains, its longest winning streak since 1973. And looking ahead, the backdrop for the precious metal looks positive. Avril, wow, look at it go.
It has recovered from the January pullback, right? Remember, it was roughly, 54.30, I think thereabouts. And then that steep slump, and now we're seeing it continuing to edge even higher. You have tariff risk, Middle East tensions as well. So overall, I think the safe haven demand as a driver is still there. Then don't forget central bank diversification as well. Overall, investors are, I think, increasing their appetite for hard assets. take India for an example. We've been seeing actually quite interesting moves in ETF flows there versus stock funds, and the regulators have recently, right, this week, tweaked some of the regulation so that these stock funds can allocate a bit more towards gold and silver. If you look at some of the other precious metals as well, those moves there have been interesting because it's pulled up the likes of silver, platinum, palladium as well. And there are some idiosyncrasies behind all this, but silver might also be seen as a bit of a laggard to some. Because of the ETF flows, they're still very sticky when it comes to gold, perhaps less so for the likes of silver. So very interesting when it comes to precious metals.
That's right. The question is whether they will outperform this year. April, stick around, because we're going to get further insights with our next guest, who has raised a price forecast for precious metals. Joni Teves, precious metals strategist at UBS Investment Bank. Joni, let's start with gold. There's no stopping it, but it's been quite a volatile metal, so to speak. I mean, what do you do with it? Buy the dip?
So we actually, taking aside the spike in volatility at the beginning of the year, I think if you take a step back, the underlying drivers why gold has been rallying for the past few years are still very much intact. So I think diversification has really been the key driver, and especially kind of the shift in investor mindsets to wanting to have a core allocation in gold in the portfolio to help diversify it. So I think that still is the main driver right now, and that's why we think that gold prices can continue to make new highs over the next few quarters.
But the volatility is a concern. At some points, it was behaving more like a risk asset than a haven.
It's a meme stock even.
Yeah, right? Given these huge swings. So do you think all the speculative positioning has already been cleared out?
So the volatility that we saw towards the end of last year and into early this year, I think was driven by a few factors. I think one key factor has been the thin liquidity in markets, so amplifying the price move. So I don't think it took a huge amount of volume of trades in order to move price action. Secondly, you did have seasonality in your favor at the beginning of the year, so very strong demand out of China. Plus, we had the flurry of macro headlines that came out very early on this year that, if anything, reinforced the diversification trend towards gold.
So do you think the worst is over and it clears us up for the uptrend?
So looking at net long positions on COMEX, for instance, that has cleaned out quite a lot. So you're now hovering around the lower end of the range since 2024. So it does imply that a lot of the froth has come out. And I think the consolidation that we've been seeing over the last few weeks is an encouraging sort of dynamic. Also the fact that you immediately saw a response from physical buyers following that dip. You saw a response from long-term asset managers buying into that dip, I think is very encouraging for the next leg higher in gold.
It is a crowded trade, however you look at it, right? I mean, how crowded when you take a look at the long positions in ETFs, for instance?
So I would say it is crowded in terms of sentiment. So everyone that you speak to is bullish gold. But in terms of positions, we think the market is still actually underinvested in gold. So we estimate that there is still a lot of room for investors to actually build positions in gold. I think part of the reason is there has been a broadening of gold's investor base. So if you take the average investor in the market, you do have some people that are starting from zero allocations and still starting to build that up. So that's why we think there's still room.
They've missed out on the rally so far.
That has been a theme as well, actually, because a lot of market participants do want to get in at better levels, and they keep waiting for a deeper pullback. But the market is stabilizing quicker than expected and at higher levels than expected. So I think that's why you get these pops higher as well, because people then have the fear of missing out the next leg and have to jump in and chase the rally.
How is the investor behavior a bit different for EMs versus the developed markets in terms of allocation and the way that they're looking at precious metals, gold specifically? I mean, this week we see how India's tweaking rules. India has always loved gold. Yeah. What have you been seeing?
So I guess one key difference in terms of the broader demand, Asia tends to be a very physical market. So the expression of exposure to gold is largely via physical products. I think ETFs, even ETFs which are physically backed, is still kind of relatively new avenue for Asian markets. And in Western markets, I guess there's a lot more kind of participation via futures and things like that. I guess another key difference is emerging market central banks. So they are really the ones that have been building gold reserves, whereas developed market central banks, they already own a lot of gold as a legacy from the gold standard. So the more active ones have really come from emerging markets.
So have we seen peak holdings for central banks, or do you see central banks picking up gold, given, the geopolitical environment right now especially?
So our expectation is that, similar to institutional investors, we think there's still room for the official sector as a whole to keep adding to gold reserves. Obviously, there's a lot of divergence within that. Some are already holding quite a lot. But then we think that there are also those that are still holding 0 to very small allocations to gold. So we expect that those will probably become more active. Our baseline is that in terms of volumes, this year we will see slightly lower volumes than the previous year. But to your point, we do see upside risks to that baseline. If geopolitical concerns escalate, then that could incentivize even more buying from the sector. And not just central banks, right? Also other official institutions.
For central banks, it's really about diversifying. I wonder, does it matter where they're storing that gold?
That's a great question, because I think increasingly, and not just among the central banks and official sector, but even among investors, it's starting to come up in conversations, thinking about where exactly to keep the gold. And we have seen it in the central bank space, where gold is repatriated back home, and so to diversify kind of the geographical holdings as well.
We are also hearing about some of these Southeast Asian central banks, for example, they're thinking about storing it in China. Do you see China increasingly playing a role in that regard?
That's going to be one thing to watch going forward, right? Because historically, a lot of official sector gold tends to be held in London at the BOE. Having that alternative location in this region will be kind of a really new development for the market. But I think it remains to be seen, and it depends on, I guess, whether it's going to be primarily Asian central banks that will be incentivized to hold some stock in China, or even broader than that.
On central banks, there's also the questions around Fed independence. I mean, we are looking at policy as well. There's a sense that in the back half of the year, maybe around midterms, if there is a weaker result, that also constrains what Trump could do. Do you see that as affecting gold demand?
So I think the midterm elections is going to be a key checkpoint in terms of kind of figuring out the outlook for gold from there. I think it really depends on what the level of policy uncertainty that we're going to face after the midterm elections, because I don't think it's just about Trump's policies, but the uncertainty of the policies that has been kind of supportive of gold diversification.
It's been quite interesting to see how silver has played catch-up in a big way as well. When it comes to the gold-silver ratio, that's decreasing. How do you see that evolving? And what does it say about where silver is right now?
So I think that for the gold-silver ratio, there's probably a bit more room to consolidate at this higher level for now, as gold and silver markets also consolidate. But I think there's room on the downside, or to retest the lows that we saw this year. Our expectation is that as gold makes new highs, silver should also make new highs. And in that scenario, we expect silver to outperform gold. I think what silver is saying, and the price action in silver is saying, is that especially when we were at the lows around 40 in the gold-silver ratio earlier this year, it was an indication that gold had run up and had become too expensive. So there was some switching, whether in investment form or physical form, to kind of to play the catch-up, the relative value trade.
It is diversification, and could also be a case where maybe now silver is the hedge. instead of gold?
It's going to be very challenging for silver to really compete with gold in that sense because it does have much higher volatility. So going back to our conversation earlier, I think the sentiment towards silver is much more tactical in nature, whereas in gold it's much more strategic. You also don't have the natural buying from the official sector for silver that gold has. So I think that's a key difference. So I think volatility in silver is likely to remain quite high because it gets dragged higher and outperforms gold on the upside, but it has the tendency to pull back a lot more violently as well.
They also have the tailwind from the industrial application, though. I mean, do you see that as something that could be more of a tailwind for them, or how does it affect as well palladium and platinum? Yeah,
so I think for the white precious metals, the supply and demand fundamentals do support prices over the medium to long run. We are, and particularly for silver and platinum, right? So we are expecting deficits in these markets to continue. So to us, that suggests that these metals do deserve to trade at a higher range than perhaps what we were expecting last year. There has been signs of tightness in the market, so the prices should be supported. But to the extent that it gets dragged higher because of the interest in gold and investor flows pick up, that does take prices beyond what fundamentals dictate. So I think that also creates some volatility.
For palladium, not so much because of the surplus, right?
Expected surplus in the long run, yes.
Okay.
So I think
what are the targets are you looking at for all four of them?
So we are looking for gold. We think that the price could average around 5,200 for this year. So that implies sort of a core range between 4,500 and 5,800. But we do think that it is possible for the market to test 6,000 in gold if we are trading at that 5,800 level. Right, $200 is no longer a big number for gold. For silver, we think that the market can average around above $100 this year. 105 is probably the average that we're looking at for this year. For platinum and palladium, I think that we have our forecast probably around or not far from where the market is currently trading, but I think there's going to be opportunities to trade the market within the ranges over the course of this year.
So what's a good entry point for gold and silver if you're trying to get exposure? Because as we said, some people are still playing catch up.
Yeah. So initially, we were saying 4,500 is a strong support area for gold, but it looks like the market has been much well supported ahead of that. So 47, 4,800 has proven strong support. So I think that's probably a good area to enter. And for silver, I'd probably be more comfortable between $70 and $80.
And for the commodity space as a whole, do you think it can outperform stocks and credit in 2026?
Commodities as a whole.
Yes,
I think that's a very difficult sector to generalize because each, especially for the broader commodities, base metals, they have their idiosyncratic supply and demand drivers, and they do respond a lot more to supply and demand factors compared with precious that are very, much more macro-driven because of gold. Whether they outperform, I think, is difficult to say, but I think because there is that overall sense of wanting to diversify, I think there is a scenario where commodities, gold rallies along with equities and as well.
Joni, thank you so much for joining us today. Joni Teves of UBS Investment Bank and, of course, our very own Avril Hong. We have breaking news out of Reuters. Nintendo planning to buy back along with share sale. Nintendo holders, including MUFG Bank, to sell 300 billion yen worth of shares. It's opening new tap plans and unwinding of strategic shareholders that would see companies including MUFG as well as Bank of Kyoto selling shares of the Super Mario Maker, according to three sources familiar with the situation, and of course Reuters as well. And also to mark this, Japan's two-year bond auction drew weaker demand than its 12-month average. The bid-to-cover ratio was 3.32, compared with 3.88 at the last auction, and a 12-month average of 3.58. The auction was closely watched to gauge the appetite of the policy-sensitive debt as investors deliberate over the latest signals from the BOJ. Well, still ahead this hour, a surprise stop in India as Washington's tariff agenda turns murky. More details on Howard Lutnick's trip to New Delhi. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside. India's been trading for about 3 minutes now. Let's do a check on how the benchmarks are doing under a slight pressure as we speak right now. The Sensex down by about 0.4%. That's on the back, of course, of pressure on software companies in particular, though we've seen foreign investors returning to Indian stocks at the fastest pace in 8 months, supported pretty much by stabilizing corporate earnings and, of course, that U.S. trade deal. Today, though, it's pretty much red across the board for the benchmarks in India. The Nifty 100 down about 0.5%, and the Indian rupee trading at 90.95 versus the USD, pretty flat versus that currency. Now, in other stories in India, U.S. Commerce Secretary Howard Lutnick made a surprise visit to New Delhi on Thursday to meet his counterpart Piyush Goyal for fresh talks. The Indian minister posted a photo of the pair along with U.S. Ambassador Sergio Gore. The visit comes just days after the Supreme Court struck down President Trump's global tariffs, leaving India's trade deal with Washington pretty much in limbo. Let's get more with our economy, trade and investigating agencies reporter Shruti Srivastava in New Delhi. Do we have a sense, Shruti, why he dropped by?
As you said, Haslinda, this was a very unscheduled trip, and he met his Indian counterpart, Piyush Goyal, who posted a picture on social media saying that he had a very fruitful discussion with the U.S. Secretary of Commerce. The trip, as you said, comes, after the U.S. Supreme Court struck down Trump's emergency tariff. And this has given, this has not only created uncertainty and confusion across the globe with countries who have entered into trade deals with the U.S., but it has also given room to maneuver in negotiations for India, while India has made it very clear that it's not considering backing away from the deal, which was agreed upon early this month between the two nations. The U.S. has agreed to cut India's punitive tariffs from 50% to 18%, but it certainly gives scope for negotiations to India. So there are a couple of things which officials have been considering, as the two sides look to formalize the deal soon. Earlier, the plan was that that an Indian team would go to Washington to finalize the deal, but that has been postponed for now till more clarity emerges on U.S. tariffs. But officials have also maintained that they would insist on safeguarding their interests in future negotiations with the U.S. and would insist on including a provision that should such a scenario emerges in future, India's interests should be protected.
But Shruti, how much room is there for negotiations between the U.S. and India, given that Trump has come out to say countries should honor the deal?
Definitely. So that's a tricky one. Yes, Trump has threatened to, raise tariffs further if countries don't honor their deals and play games, as he said. But as I said, there is no consideration or rethinking on the deal that has been agreed upon between the two nations. India is very clear that it will, it will not renege on the deal that has been agreed. It's trying to balance its trade interests without, having a friction with the Trump administration, but definitely it does open scope for a lower rate because the tariffs based on which the deals were done that has been termed as not legal by the Supreme Court.
Well, it's not just the U.S. trying to make deals. Canada is also expected to do so. Mark Carney in India this week. What is expected from his visit?
Yeah, so this is Carney's first visit to Asia. He would be coming to India. From here on, he would be going to Australia and Japan. Now, this deal, this visit comes as India and Canada have tried to, leave behind the rupture in relationship that happened 2 years back and move past that. This visit comes as Carney is also trying to move away from Canada's US-centric policy and reach out to Indo-Pacific. So during the trip, the two sides are expected to, discuss on nuclear power, on quantum computing, education, critical minerals, and perhaps formalize some of the deals during this visit. There are expectations that we can see a deal in uranium. India is considering buying more energy from Canada. These are some of the issues which are on the table. Also, India and Canada are expected to formalize the terms of reference for trade talks so that they can have an FTA by perhaps end of the year.
Shruti, thank you. Economy, Trade and Investigating Agencies reporter Shruti Srivastava for us. Now, Indian investigators have seized tycoon Anil Ambani's $410 million Mumbai condo, escalating a sweeping bank fraud inquiry. It comes after the country's anti-money laundering agency alleged Ambani defaulted on a $4.4 billion worth of loans. We go to Bloomberg News wealth reporter Advait Palepu for more on this story. Advait, why is Anil Ambani in trouble? What are the allegations? What's been his response?
Good morning, Haslinda. So Anil Ambani's been in trouble for over a decade. His company started defaulting on bank loans as far back as 2016, 2017. And the banks did try to pursue some restructuring with the group, but eventually had to push his businesses into the insolvency courts. To be sure, he still has operating companies in the power sector and infrastructure sector, but his shadow banks and telecommunications arm eventually went into the insolvency courts and certain assets were sold. Some of these companies were sold off to third parties. But the allegations are that Anil Ambani had raised a ton of debt at these companies, but the funds were misutilized. Either the loans were evergreened, the money was siphoned off abroad, or passed on to third parties to make personal investments and for personal use. So the Enforcement Directorate, after the banks finally filed a complaint and a fraud and tagged his account as a fraud account with the RBI in July last year, have started pursuing their investigation. And in the last 6 months, we've seen a lot of enforcement actions. They've earlier seized properties, commercial offices, land, and various books of accounts. And as of Thursday, they have said they've seized his home in an upscale neighborhood in Mumbai. It's significant because in just 6 months, the momentum in the case has got off to a high. There's been momentum in the case in the last 6 months. And earlier this month, the Supreme Court has also said that the investigating agency, the Enforcement Directorate, has to form a special investigations team to look at the entire group's issues.
Advait, thank you. Bloomberg Wealth reporter Advait Palepu there for us. Still ahead, we're looking ahead to India's GDP. Former Reserve Bank Governor Raghuram Rajan will be joining us to discuss the economy amid warnings that AI could impact the country's IT exports. Plus, NAB's Sally Auld on navigating tariffs. This is Bloomberg. Welcome back. You're watching Inside. U.S. and Iranian officials have agreed to reconvene nuclear talks as soon as next week. Mediator Oman earlier said both sides made significant progress in Thursday's talks. For more, let's bring in Bloomberg Horizon's Middle East and Africa anchor, Jumana Basachi. And Jumana, the fact that they're meeting again, that is a pretty good sign.
Yeah, that is a good sign, Haslinda. And I would say it was a fraught day of discussions yesterday in Geneva. Very long day of multiple rounds of discussions. There was a pause in the middle. Mediators came back to the table again. And then very late in the evening over here in the region, that is, the Oman Foreign Ministry put out a statement describing the talks as being constructive, that significant progress had been made, and that more discussions are going to be held next week in Vienna. Now, it's important to note here that we've heard from Iranian officials, we've heard from the Omani mediators, but we have not had formal commentary yet from the United States on how these talks went. Earlier on, there were reports that the Oman mediating team will be meeting with the U.S. Vice President J.D. Vance later this afternoon. And in terms of what was discussed, well, again, many reports emerging overnight about the context of those discussions and that there was a lot of debate around enrichment and around around the level of enrichment that the U.S. are comfortable with. In addition, with the U.S. pushing for Iran to hand over their already enriched stockpile. Remember, they're sitting on about 400 kilos plus of already enriched uranium. And the other point as well is that the American side are really pushing for no sunset clauses, which you will remember was a key part of that JCPOA agreement that prior President Obama had agreed with the Iranians back in 2015. The U.S. this time around are saying that there should be no sunset clauses, that if Iran adhere to no enrichment or little enrichment criteria, they have to stick to it indefinitely. From the Iranian perspective, of course, they have been pushing for the lifting of sanctions relief. And again, reporting suggests that the Americans are pushing back there and saying that they will only allow for limited sanctions relief unless they are clear that the Iranians are sticking to their side of the agreement. So it still feels as though there's a lot of daylight, there's still a lot of distance in the two negotiating teams. But per the comment put out by the Omani mediators, there will be technical discussions, quote unquote, taking place in Vienna next week. That being said, I should still say that the chances of military action is still quite high. That second aircraft carrier, the Gerald Ford, is looking to arrive off the coast of Israel at some point this afternoon. And so again, once again, going into the weekend with the sense of high alert that there is still a possibility of kinetic action, despite the fact that the discussions are continuing.
There seems to be no compromise, no meeting point, because the U.S. walked away saying there has been little progress, we're disappointed. But Iran said there was good progress. You got to wonder how they will meet and, what will happen when they meet again next week.
And I think also what this comes down to, Haslinda, is what the U.S. are really trying to achieve here. Does President Trump want a deal? Does he want a deal that could be described as a quote-unquote better deal than what his predecessor had? Or are they looking for something more substantial? Are they looking for blows that will completely wipe out military infrastructure, even more blows on the nuclear infrastructure that Iran is sitting on? Or go one step further and look for quote-unquote regime change? So at this point, it also is unclear what exactly the U.S. are trying to achieve. From the Iranian standpoint, obviously their main goal here is, number one, regime survival, but also to thwart the U.S.'s potential military action on Iran. And the way that they do that is by ensuring that these negotiations become as protracted as possible. So we're in a situation where Trump has already set that ultimatum of 10 to 15 days, which, by the way, by calendar translates to March 1 to March 5. But here we are again looking at a potential another round of discussions. So will President Trump adhere to that timeline, or are we going to be sitting in front of what could be multiple weeks of discussions between the two sides in the hope that they can breach some of the disagreements?
That's right. Trepidation this weekend. Jumana, thank you. Bloomberg Horizons Middle East and Africa anchor Jumana Basachi for us in Dubai. On the back of that, let's do a check on how oil prices are doing right now. Pretty steady. The last I checked, taking a look where we are in terms of Brent crude, $7.78, and New York crude at $65.27. Pretty flat as we speak right now, as the U.S. and Iran hold talks next week. Let's get more on how geopolitical risks are likely to impact global growth. Sally Auld, chief economist at National Australia Bank. She has a career spanning over 25 years in financial markets and economic research. Sally, good to have you with us. We talk about how oil is a crucial part to growth, and some say that if there is an attack on Iran, oil could get to 75 within 10 days. What implications are there for the world and growth?
Yeah, I think it's interesting because we know there are lots of geopolitical risks around at the moment. That seems to be a function of the world that we live in at the moment. And I think as investors and market participants, what we need to try and do is discern those risks that have the potential to be impactful for global growth and possibly inflation. And so that really helps you narrow down the focus to those geopolitical risks where if they go wrong, we could see a spike higher in the oil price. And of course, this risk in the Middle East between US and Iran is precisely one of those. So, oil has been, Brent at least, reasonably well behaved. It's sort of traded a 60 to 80 range, over the last couple of years. And really for most of this year and towards the end of last year, we spent a lot of time towards the very bottom of that range. We're now in the middle. And I think, if we were to see an escalation of risks or possibly some conflict, then that's quite easy for oil to move up into the top half of that range, and that would be, I think, manageable for the global economy in the sense that the starting point for global growth is pretty good. Like most people, including ourselves, have really only spent the last 6 months revising up global growth forecasts, and it feels like so far in 2026 the global economy is on a good footing. So I think 70 to 75 is manageable. If we started to punch through $80 a barrel, then I think that becomes quite a different story, and we would start to fret about downside risks to growth.
At what oil price would you start worrying about inflation? Because when we started worrying about inflation, it was because oil went to in excess of $100 a barrel.
Yeah, that's right. So not so much the level, I guess, of where the oil price is, but the change that's going to be important. And so if we did see Brent move up into that 75, 80, then we would start to see an impact on inflation globally. And, oil is one of those things that pretty much every country needs. And from an inflation perspective, that's the common shock to inflation. Now, there'll be variations. Oil exporters benefit relative to oil importers, but, generally oil price shocks are not good for growth, and they're not good for inflation. Previously, central banks, their way of thinking about that was to say, listen, we just look through the price impact and we care more about the growth impact. But that was a very different inflation environment to the one that we find ourselves in now, where, we've just sort of dealt with a huge spike in inflation. Inflation's come down, but in most countries, particularly in that developed market complex, inflation's sticking at that higher end of sort of 2 to 3%. So we're sort of there, but not quite. And so I do think that will probably make central banks perhaps a little bit more sensitive to gyrations in inflation than might have been the case.
And speaking of inflation, of course, PCE is out. Is the market pricing it right?
Yeah, it's interesting, isn't it? Because PCE is basically sort of hanging around 3%. That's a long way from 2%. And I think has started to prompt some discussion from FOMC members that actually, with the labour market stabilising, maybe it's time to turn attention to some of those risks around inflation. The market's still very convinced that this is only a temporary story, and that by the time we get to the middle of the year and into the end of 26, that the Fed will have scope to cut rates. But I certainly think the backdrop of US growth being okay, labour market stabilising, and inflation well above that 2% target means, at least for the next 6 months, I think Chair Powell and his committee will be pretty resolute in not moving rates.
Some are, in fact, suggesting that 3 perhaps is the new 2.
That's right. But I think, if we take Chair Powell at his word, at least, in the sort of final innings of his chairmanship of the committee, I don't think that's how they see it. And certainly in Australia, the Reserve Bank has been surprised at that acceleration in core inflation, and I suspect that might make some other central banks just a little bit nervous about declaring victory on the inflation story. Certainly markets don't seem to think that 3 is the new 2, and when you look at break-evens in many markets, they're very consistent with central bank targets. So we'll wait and see, and obviously we're facing into a change in Fed leadership in the middle of the year possibly, and so that may bring a different complexion to the story. But I think while Jay Powell is in charge, I think he's been pretty resolute in saying 2% is the number.
The market's been looking at the divergence in monetary policy and looking at opportunities to trade that. In terms of the economies, I mean, do you think countries like Australia, for instance, are on the right track in doing what it is doing, which is hike when the rest are actually cutting?
Yeah, absolutely. And so I think one of the themes for 2026 is going to be, far more dispersion in macroeconomic narratives across different countries. We've had this period of 5 or 6 years where we all faced into too low inflation before the pandemic, then it spiked higher, then it came down, very synchronised macro outcomes and hence very synchronised policy responses. And I think as we go through 2026, that will no longer be the story. And Australia, I think, is a really great example of that. Quite a unique and idiosyncratic narrative in Australia where we are capacity constrained. The economy picked up speed more quickly than people expected. We hit those capacity constraints and we're now fronting into inflation, which has actually accelerated quite a lot in the last 6 months. And so for the Reserve Bank, there's no other way around this. They have to take some heat out of the economy. They have to create some spare capacity in the labour market, slow growth and get inflation back onto that track. But I suspect they will be quite wary of declaring victory on that process too soon, maybe having been a little bit humbled by what happened in the back 6 months of last year, but absolutely believe that this modest adjustment in policy that we're seeing in Australia is the right approach.
And might the next move still be a hike?
Absolutely. We think at NAB they're not done yet. And I think the reason for that is just simply the shift in the inflation backdrop is quite significant, and the forecast revisions they have made are of a sufficient magnitude that they cannot deal with that problem with just one rate hike, and so we think they'll go again in May.
And what it means for the Aussie dollar, especially against a weakening USD.
Yeah, that's right. So the Aussie's been interesting, one of the best performing currencies so far this year, and that's partly a consequence of that weaker US dollar backdrop that you mentioned, but I think also a consequence of some pretty specific Aussie factors around, you know, the repricing of front-end rates and that yield differential moving wider. We've had better macro outcomes than expected. That's always a good thing for currencies. And we are very highly correlated with the Chinese currency as well. So as it's been moving higher against the US dollar, that's helped. And don't forget that the global backdrop is also pretty conducive. It's been really one of global reflation, better growth, higher commodity prices. So it's been the perfect sort of storm for the Aussie, which is why it's very
All
comfortably.
stars are aligned.
That's right.
Thank you so much for that, Sally. Sally Auld, National Australia Bank. Still ahead this hour, Baidu sales shrink for the third consecutive quarter as the company struggles to find its footing in the AI race. That's next. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Chip stocks have sent Asian equities surging, but Wall Street has been digesting a rewrite of the AI story as investors reassess the winners and the losers. Nvidia, for example, suffered its worst decline in 10 months after the company's latest forecast failed to dispel fears of an AI bubble. For more, let's bring in our Asia Tech correspondent, Annabelle Drulis in Hong Kong. And Belle, Nvidia definitely had a bad day. Then Bell changed the narrative again.
Dell did change the narrative again, certainly not myself, but Dell did change the narrative in late trade. Actually, we saw shares that jumped and extended trading because really around that outlook around their AI server business, because they're saying for the current fiscal quarter, they're going to be generating $50 billion worth of AI server revenue. So, yeah, I mean, the COO, for instance, we heard from him during the earnings call. He's saying that this is something that's really transformational for the business. Of course, Dell servers, they're designed to run AI workloads, and they've been really attracting customers from companies that rent computing power, essentially. And one of those is the so-called neo cloud provider, but that's CoreWeave. You can see there as well, because that was another very interesting move in late trade, and also just really reflecting what has been a very persistent concern we've seen throughout the tech earnings, but around capex and perhaps not seeing enough ROI, because essentially they said that their losses widened to 89 cents in the fourth quarter of last year, essentially. Analysts had been looking at 72 cents on average, and that really speaks to how much the company is needing to spend in order to continue to attract customers like, as I said, Dell using their products, but OpenAI, Meta, Microsoft, for instance, that are renting cloud computing space or using theirs, but certainly is a costly exercise because they're looking at capex this year of $30 to $35 billion.
And Bell, we're getting more insight into the effects of memory chip crunch. Tell us more about that.
Yeah, this has been one of the really interesting topics of the day. Of course, we continue to track memory chip, really the crisis that's been going on for several months. IDC is saying it could actually be underway until well into next year as well. But it is that impact that you see also being reflected in Asian equities. The cost be the true standout with the likes of SK Hynix, Samsung, that just have so much pricing power and that are redirecting their workloads essentially to production of HBM. That is having a bearing on the smartphone market. Of course, it doesn't have the same level of access to DRAM, and then that drives up smartphone prices and smartphone costs of production, and that is going to also mean less output essentially this year, just given those supply constraints that are in place. So the overall reading from IDC is quite a significant contraction coming for this year. But take a listen to IDC's Brian Ma.
just the pressure has been quite immense on the market where, as you pointed out, now we're looking at a 13% contraction. That's putting a lot of pressure on a lot of Chinese vendors, and accordingly so, that actually is about 30% of the total market. So you can imagine that part of the market, when you look towards the tail end of 26 and into 27, we're looking at most of that going away, and that's going to be quite tough.
Yeah, so I think he really underscores here just how asymmetric this is. Yes, you may have higher-end device makers like Samsung or Apple that definitely have more capital, but also longer-term supply contracts in place. The cost of memory for lower-end devices is a really high proportion of each device, and so IDC is saying the Chinese smartphone makers rather like Oppo or Vivo or Huawei or Xiaomi. I mean, there's a lot of them, and particularly ones that are targeting the markets like India, for instance, with their lower-end and lower-priced devices are going to be disproportionately affected this year.
Annabelle Drillers, we thank you so much for that. And now here's a look at how Baidu shares traded through the morning session in Hong Kong after it reported a drop in revenue for the third consecutive quarter. Bloomberg Intelligence senior analyst Robert Lee says while the results were not as bad as expected, the Chinese internet firm needs to deliver sustained improvements to regain investor confidence. Earlier today, Citigroup Global Markets Asia told us they think the stock is undervalued.
Even if you put the legacy search business at zero value, it is still, not necessarily trading at the current value, which we still think is undervalued at this point.
And Robert Lee joins us now from Hong Kong. Rob, is it too early to expect a turning point in Baidu's earnings?
Good morning. I think the answer to that is absolutely. Whilst the numbers or reported numbers were slightly less worse than feared, and I use that wording deliberately, there was a little bit of cost cutting in there which made the reported profit come in slightly ahead of expectations. But taking a step back, these earnings at the operating profit level were still down over 40% year over year. And the main reason for that is the ongoing concerns and difficulties in their core search engine business, which is largely driven by advertising revenue. So as consumers in China turn to other outlets, as there's increasing competition in that market, advertisers are placing their dollars elsewhere. Now, the concern from an investor point of view is that search advertising business is the core cash-generating engine that funds the entire business and supplies the internal cash flows to fund their loss-making AI ventures. And then very briefly, if you look at their AI side, whilst they're getting good client traction, those businesses in aggregate remain loss-making. So it's hard to call the Q4 numbers as a turning point. If we are going to see that, that remains some quarters away with considerable risk and uncertainty on that time frame.
And Rob, it's been quite a big week for tech generally. Citrini's Doomsday Report pretty much dominated headlines. What did you make of it, Rob?
Well, in my earlier days, I used to be a great fan of science fiction, and I would say whilst they painted quite an extreme scenario, that's exactly it. I mean, it's a potential scenario, but really at one extreme. And also, they didn't go into any specific detail in trying to flesh out their thesis. And if we, for those of you who are scholars of history, or even old enough to remember the dot-com boom, there were concerns when the internet was really increasing in popularity that it would have a major disruptive impact, negative disruptive impact on various industries. And as we now understand, 20, 30 years later, it's actually been an amazing productivity tool and has opened up so many, new business ventures or whatever. Even for scholars of history looking back to the 19th century, if you remember, there was the Luddite Revolution, where the weavers and spinners in England at the height of Industrial Revolution were worried that mechanization would lead to massive job losses. That didn't happen. So I think the way we should look at AI is as a potential, a major driver of productivity and efficiency tools. Of course, it will take out jobs in some sectors, particularly those that are more routine in nature, but is AI going to be the driver of mass unemployment? Is that going to have a major negative impact on employment growth and economic growth. There's no evidence to suggest that whatsoever. And whilst I remain very cautious on the ability of the software companies to monetize their AI investments, I think ultimately for select companies, it should actually augment and enhance their product suite and actually drive some incremental savings there.
And of course, that report coming amidst this apocalypse, I mean, that's driven the sell-off in U.S. software stocks. Do you agree? Do you share those concerns?
Well, again, if you look at, obviously, Anthropic has been at the heart of those concerns, and with some of the tools they've rolled out, sure, for very routine tasks, for example, the drafting of legal documentation, which tends to be quite routine and quite repetitive, absolutely, AI bots or AI engines can potentially replace in those areas. But I think, again, if you look in a China context, a business like Tencent, Tencent is using AI to enhance and augment its products, whether those are consumer-facing products like WeChat or internally within its business to enhance the placing of advertisements. And obviously, AI is certainly proving itself as something that can drive efficiencies in coding and software development, and Tencent is certainly using it in that way. Again, are we seeing any major financial benefit from Tencent at the moment? Then the answer is no. But I think in terms of broad-based companies like that, overall, by developing these software engines in-house and models in-house, there's certainly scope to improve efficiency within their internal business. So I think ultimately it's the bigger firms like Tencent should win out.
Right. Rob, thank you. Bloomberg Intelligence Senior Analyst Robert Lee there. Still to come, staying on the tech theme, and former RBI Governor Raghuram Rajan will be weighing in on a report from Citrini Research warning AI could hit India's $200 billion IT export sector. That is next. This is Bloomberg.
The markets have been selling software for almost a year now on the AI threat. But they really accelerated in the last few weeks. And this is, the problem with this, if you're long software, is there's nothing to actually disprove the thesis, because the thesis is a few years out. It's not today, but you have not much to stand on, because ultimately that thesis is going to get stronger as AI itself gets stronger.
And that was Lotus CIO Alap Shah speaking with Bloomberg earlier this week. He was co-author on a Citrini report that tanked software stocks, and he says pressure will only build as AI gets stronger, and even called for a tax to cushion job losses. And the same report has a very stark call on India. It argues that AI will wipe out the country's giant IT sector, and warns that a shrinking services surplus could plunge the rupee and strain the economy. Bloomberg senior editor Manika Doshi joins us with more. Suffice to say, it was a gloomy report. How gloomy was that report on India?
Very doomsday, or science fiction, as your former guest just said, has. And that theatrical touch of in 2028, India calls the IMF, suggesting that things will be so bad that we will need a bailout, predicated on the argument that the report makes that the IT sector, like you said, will tank. It will create a balance of payments crisis. Look, I mean, there are some interesting sort of theory points in that report. And the best way I can put it is that, yes, we've seen the kind of fear playing out on the IT sector here in India. We've seen what's happened to the NSE IT index. I mean, significant losses, the most in decades. But I also need to ask this question. At the end of the day, AI will require deployment. It's not going to automatically deploy into millions of businesses, not just across the country, but across the world. That's going to need engineers. India does have the largest pool of engineers, even if at this point they're not all fully AI skilled. Now, that said, this is a real threat. We need about 8 million jobs a year till 2030. That's what India's chief economic advisor said. And he said this last week at the AI summit, which you were attending, Has. And he acknowledged the size of the threat, or the depth of the problem, by saying that for India, this will be a stress test for state capacity. And he also said, if AI displaces faster than we can skill humans, and if productivity rises without employment elasticity, we risk squandering our demographic window. So, yes, it might not be as bad as the Citrini report puts it out to be, but it definitely is going to be a challenge.
And what helps is that India has that digital infrastructure. Its starting point is quite different. Manaka, do stick around. Let's get perspective now. Raghuram Rajan, professor at the School of Business at University of Chicago Booth and former Reserve Bank of India governor. Professor, always good to have you with us. This doomsday scenario, what do you make of it? Overstated and perhaps a lack of understanding of how the economy works?
Well, let's start with, yes, there will be disruption in the software industry, that AI will replace a lot of the routine coding. Maybe all the stuff that still sort of works with COBOL will get replaced. But yes, as Menaka just said, you will need people to supervise the deployment. Yes, my daughter can do vibe coding, but that doesn't mean she can handle the massive systems for a large enterprise and ensure that that works really well, because what you need is no errors in some of these large systems. So somebody will have to do that. Presumably, India's software firms will employ AI as they retool themselves, reskill themselves for a new future. So one is, it sort of assumes a straight line. These big dinosaurs can't change. They will not use some of the AI tools that are there. We already see some of them sort of signing up with Anthropic, with OpenAI to use those tools. So that's one. The second is what is traditionally called the lump of labor fallacy, that there is only so much work, and that if you have new tools, that work will be, most of it will be automated, and there'll be a lot of unemployment. What we've seen again and again is if work becomes more productive, cheaper, there's more of it. More firms will use software in new, different ways, and so you would expect that to change also. But the reality is true that that we've seen very little hiring in the software sector. To Menaka's point, 8 million jobs a year, that's not, the software sector has been providing some, especially higher-end jobs, but it counts even now for about 6-8 million jobs in India overall. And so the Indian services story can still persist in many other areas outside of software. But yes, AI will be a challenge.
In terms of how it will disrupt the sector, how do you see that playing out, Professor? And, what kind of steps, moves should the government adopt to ensure that the worst-case scenario does not play out?
Well, first, I think early days, this is not at this point something that calls for government action. I think what the big software firms have to do is incorporate whatever AI they can throughout their systems so that they increase productivity. They're already doing it with some of the tools that already exist, but they have to keep abreast of AI as it comes out and convince their clients across the world that they're getting the best of software at the cheapest point possible. That may mean, muted hiring. We've seen TCS already say that it's going to lay off a bunch of people. You're going to see silent layoffs in a bunch of other software firms. They may not announce it so clearly. And it also means that many of their employees have to retool really fast. But this is not something they cannot overcome. And if, in fact, the cost of their services becomes cheaper, maybe they get more business. Remember that many firms in the U.S. and across the world have yet to implement AI in a big way in their processes. So I think there's a lot of work yet to come in rolling things out. For example, using the data that your processes generate in firms, putting AI to work in improving processes based on the data collected and outcomes. That is something that needs to be done, and that's where software firms that India has can play a big role.
Professor Rajan, technology rarely works in this linear, speedy fashion, as at least the Citrini report has visualized. Can you talk us through what you have seen happen when large technology shifts have taken place, especially in countries like India, the time it took to move to a software economy, the time it took to move to a digital economy, and then therefore the time it will take to move to an AI economy?
I think you put your finger on the nail here, which is really you see the fastest use of technology in the people creating the technology. So sometimes there is a sense that this is going to move really, really fast. What they don't see is adoption outside the frontier sort of is much longer. I remember an Economist article, and I may have the dates a little wrong, but they're talking about the development of the telephone exchange without human operators. And it actually was invented in the 1920s. But the last human operator was taken out in the United States in the mid-1980s, so around 60 years for the technology to be fully rolled out. Things take time, and the firms that are not technology savvy will take more time. That said, I think in industry after industry, everybody's looking at each other to see who's going to roll out AI in an effective way sooner rather than later. And everybody's waiting for the Barnes and Noble moment, so to speak, when suddenly the industry sort of sees there's a faster, cheaper way of doing it. That's when Amazon came into the book business, and the old dinosaur Barnes and Noble goes out of business. But for every industry, it can be different. It can be a different application of technology. We're seeing some of it, for example, in payments. We saw Block announce, for example, it was laying off 4,000 people. Now, many of those may be in software development, which is the frontier industry right now where much of the change is happening. But rolling out into, more plain vanilla industries may take more time. And I think that will allow many industries time to adjust, but also time to use AI rather than just be displaced by it.
Okay. Also, Professor Rajan, from a macroeconomic policy point of view, you've been a proponent of services-led growth in India. But do you now feel in hindsight, as we see this technology play out, that it will impact white-collar jobs more than blue-collar jobs, especially the top-level white-collar jobs, and therefore by doubling down on manufacturing, even if it meant through incentives and subsidies, the Modi government's policies are broadly in the right direction, even when it comes to the heavily subsidized semiconductor mission?
I think that's completely incorrect in the sense that technology is going to reach the manufacturing sector also. It already has. And robotic technology is going to get better, is going to get more efficient. But also, protectionism is rife in the manufacturing sector. So we need all the manufacturing we can get. Don't get me wrong. India should do whatever it can do. But, to the extent of subsidizing really, really costly investment in things like chips without getting anywhere near the frontier, far better to redeploy that in training people, in our educational sector, in getting R&D going. It would be nice for India to have frontier AI models or frontier applications of AI. That requires improving the quality of our engineering, which is already pretty good. But the broader point I would make is services is a big area. Now, I think software is being hit now. It will change. The routine stuff will almost surely go, and that was on the cards. Legal discovery, ferreting through hundreds of thousands of pages of stuff in legal reports, that could be automated, is being automated. But I think the more sort of creative parts, actually making legal arguments, offering medical advice, of course, augmented by AI, but medical advice at a distance. These are areas that I think for some time will still continue. And of course, what you would hope is a lot of it would be augmented by AI. So I think the reason many firms are moving to India, because highly skilled service people, a consultant, is 1/5 or 1/6 the price of a consultant in the West. And that consultant in India has the same access to the tools, technology. And as you see from Indian advertisements, Gemini, OpenAI, ChatGPT, etc., advertising widely in India, I think this is leveling the playing field across the world, and India's labor cost advantage here makes a huge difference. So it's not just software, it's a whole variety of highly skilled services. But really, and let me end here, the thrust is not so much on the highly skilled services, but the moderately skilled services, carpentry, plumbing, which are really essential for urbanizing India. That's where the jobs are going to be, not necessarily in low-skilled manufacturing, within in many parts of the world is being automated away. So I think the services story still holds. The upper end will have to adapt, but the moderate end is where the jobs will be, and that is where we need much more skilling and training to create those jobs in India.
Professor, earlier you talked about how this will not happen quickly, it will not happen overnight. But if you take a look at the developments in AI, the capacities are doubling every 7-8 months. So it is a revolution. If governments don't take action now, put incentives in place, train their workers very quickly, they will lose out. I mean, what's being done? What needs to be done then for countries like India?
Absolutely. I mean, I agree that the time for action is now, but it's really in allowing or enabling people to adapt as best as they can, as quickly as they can. And this is where I think, Menika brought up an important point. India is spending tens of billions of dollars in subsidies for chip manufacturing. Those tens of billions of dollars, if they went into our universities, both creating new ones, but augmenting the old ones. I was just back to my alma mater, the IIT, Indian Institute of Technology, Delhi, which requires so much investment in order to give the kids in college right now a much better educational experience. I think investing in people is really the name of the game right now, whether at all levels, at the higher levels, but also in skilling the moderate levels. And that has to be done today, but not just in India. This is something the US also should be thinking about. Let's not just point the finger at immigrants and the rest of the world, but let's look inwards and ask, is the United States, where 70% of workers are in the service industry, is the United States ready for the kinds of disruptions that will come? And no doubt, and you make an important point, that the disruptions will come. The pace we can argue about, but they will come, which is why we should react today in terms of public policy. And that is largely about enabling rather than disabling sectors.
Professor Rajan, how do you see the impact of this playing out on India's very large, medium-sized enterprise business sector? I feel like, the large top companies, the big conglomerates, the Adanis, the Ambanis, the Birlas, the Tatas will adapt, and will spend the money required. So far, some surveys seem to suggest that Indian companies are devoting only just about a fifth of their IT budgets, and these are the large companies, towards AI deployment of any kind or proof of concepts. But I'm concerned about the impact on India's middle sector. It is already an uncompetitive sector by many measures. Do you feel that this imperils that middle layer of growth significantly?
It's a great question. And I think this is where, if they could seize the opportunity, I mean, we talked about IT becoming much cheaper, data analysis and processing becoming much cheaper. So for many of these small and medium enterprises, to the extent that the IT firms, the software firms lose business outside, if they start sort of looking inwards and proposing sort of solutions to what some of these medium-sized enterprises to their processes, and at a price that they can afford, I think this would be wonderful in improving efficiencies right through the economy. So this is a potential opportunity. Let me give an example with medical. I've been talking to some people in the medical area in India, and they say many hospitals would benefit hugely from improving the quality of the data, from having a common database, etc., all the usual arguments. But they say they simply don't want to spend on IT. So Indian IT firms, when they go to offer medical sort of services to improve data and data analysis, they're typically looking to the rest of the world. There's a huge opportunity in India, and as you know, India has tremendous needs for medical services. So if they could refocus on some of the Indian hospital chains and so on, but give them services at a price they can afford, which they will be able to do once they're more AI enabled, I think there could be lots of opportunities. So yes, they do need to change, but it may be that change is easier when you look forward. I don't want to be entirely optimistic because change is a challenge, but I think there are possibilities here.
Can you wear your former central banking hat for me? And even if this technology were to play out in a far more drawn-out, volatile fashion than what this report seems to suggest, as a former central banker, how would you be looking at the correlation between productivity, wage growth, and inflation? What should we be watching out for play out in India over the next few years? And what should our central bank be prepared for at this point in time?
So on the issue of, let's assume the report comes true and there's massive layoffs in the software sector, etc. I mean, that's not something the central bank can actually do anything about because, lowering interest rates, but really there's a mismatch between the skills that people have in the software sector and the jobs available. That's not going to create a whole set of new jobs in the software sector. They'll have to migrate to other areas. And there, I think the central bank can only have modest effect. But that said,
Professor
I think
Rajan, sorry to interrupt you. Sorry to interrupt you, but there is a collateral impact of a significant, let's say, a set of layoffs in the IT industry. It will play out in the real estate industry. It will play out on consumption, in India.
Yeah.
And so effectively, it will play out on growth as well, right? Because right now, it's only the top 300, 400 million people in India that are consuming to support this 7.4 or 7.6% rate of growth.
Right. So to the extent it plays out in the normal variables that the central bank looks at, absolutely, it'll have to do the usual stuff it does. What I was trying to say is it's not going to look at the sector alone and formulate policy as on that basis. It's going to look at the overall parameters that it usually looks at and formulate policy on that. Also, I think the issue for AI, I mean, we talked about the positive side, that there can be a lot of investment in India. Maybe not so much, we're already talking about massive data centers and so on. So there is a demand side boost possible from AI, even as the supply side also becomes more productive. And which effect dominates is really the question, whether in the US or in India. Does AI imply lower interest rates, or does AI imply higher interest rates? For now in the US, you might argue that you're seeing a lot of the demand side, the massive investment in AI data centers and so on, that's would tend to push up growth, but push up also the demand for capital. That would tend to imply higher interest rates. To date, despite the Citrini report and some early signs of layoffs, we haven't seen massive layoffs as a result of AI. So, the supply side effects are slower to some extent. We've seen some productivity increases, but they're probably not as much AI as other factors.
Professor,
so you don't
when
see
you take a look at the...
Sorry, Has.
Go ahead, Maneka. Go ahead.
I just had a follow-up, Has. You don't see this having a deflationary impact, in terms of growth in the Indian economy?
It depends on the offsets, right? Supposing it implies a whole lot of new investment that has to happen in India in order to react to the changes that AI demands. That could be demand positive. And so it need not be deflationary. We have to see which the greater supply side as a result of improvements in productivity, etc., versus the greater demand side. And of course, the external side effects that you're talking about from maybe less demand for software services. So it's more complicated than saying it would be directly deflationary. It depends on how everything else plays out.
Professor, when you take a look at the markets, foreign investors have been pulling money out because India, it seems, is a non-AI play, and now India is competing for AI investments with AI leaders the likes of Taiwan, Korea, even China. How do you think this might play out? Can India compete competitively?
I think India has to pick its battles. That was true of the chip industry, but it's also going to be true of AI, right? The kind of massive investment in foundational models seems something that big companies in the United States can afford, but whether it's something that will generate the returns over time is a big question mark. They're competing fiercely. And I think at this point, just as China is doing, rather than compete on foundational models, maybe it makes more sense to compete on applications as well as on derivatives of the foundational models, maybe grab some of the parameters and have smaller, more focused models. Ultimately, India needs appropriate AI technology, appropriate in the sense of being cheap enough for its firms to use. And I think focusing on those applications right now until the dust settles on which kinds of foundational models and how much becomes clearer. Maybe down the line, the technology for building these foundational models simplifies dramatically. And I think the idea that the train is leaving the station, if you're not on it, you're left behind, maybe that's not so true. But India needs to keep a watch and I think pick off the pieces that make most sense for it right now.
Professor, I'll be remiss not to ask about the Indian rupee because the Citrini report did say that it expects the rupee to fall 18% versus the USD should that doomsday scenario were to take place. Your thoughts on where the rupee is headed and what should we be looking out for?
Well, I think, predicting exchange rates is a fool's game. Yes, if Indian exports collapse, the rupee will fall appropriately so at that point because it makes sense to have more competitive industries. But we're very far from that right now. So let's not get overly wound up in science fiction and think that's the outcome. Again, it assumes a straight line. It assumes no adaptation. It assumes that there aren't new sort of businesses that substitute. I'm sorry, there's kind of disruption here. But anyway. I think that's. I don't foresee the rupee anytime soon collapsing at that rate. Let me stop there.
Professor, thank you so much for your time today. You've been very generous with your time. Raghuram Rajan, Professor, School of Business at University of Chicago Booth, and, of course, our very own Maneka Doshi. Before we go, here's a look at our guests next week. We're live from the IMF's Asia in 2050 conference in Bangkok, where we'll be speaking with its chief, Kristalina Georgieva, on Asia's role in shaping the global economy, plus catch our interviews with Sri Lankan Central Bank Governor, as well as Rebellion's CEO. That is it for Insight. This